Hey, listen, we're here to talk mortgages and what's going on in a very, I guess, fluid in lending environment these days. Things are changing frequently. So let's get an update about what's happening. So give us a little bit of an update of what, first off, is what's happening with mortgage rates. Where do you see them going in the future? What's the word on the street? Let's talk a little bit about mortgage rates.
So I'll backtrack a little bit and look at what was happening pre-COVID. Interest rates were starting to drop a little bit in the height of COVID. So right in the middle of March, all of a sudden interest rates actually went up, which was kind of surprising. And the primary reason for that is that pricing for fixed rate mortgages is based off of bond yields and then a spread over top of those bonds. What ended up happening because of COVID is all of a sudden that spread increased significantly because banks are wondering, how are we going to sell these bundles of mortgages now if people were worried about the ability to actually pay their mortgage? So for a little while there, even though the bond rates had dropped, interest rates had actually risen for a short period of time. But since then, the spread has been decreasing. Bonds have been flat for the last 5 months or so since March. And that means that fixed rates have been dropping. Now, if we look at where we're at today and what I'm predicting moving forward, those bond spreads have come back to more normal levels. And so I think we're actually either at or very, very close to the bottom end of interest rates. Generally speaking, if you look at a bond rate plus about 1.5 to 1.8%, that's usually where fixed rates are. And we're right in that window right now. So if I look at bonds moving forward, I don't really see them changing a whole lot. And I also don't really see, therefore, fixed rates moving in the next little bit.
So, I mean, fixed rates, a 5-year fixed, I know I've talked to some who have gotten, who've gotten rates below 2%. Yep. Usually in the rental market, I've heard stuff at 2.1, as low as 2.1. And probably you think that might be the bottom? I mean, that's pretty low.
Pretty close. Yeah, pretty close to it. So yeah, just looking at where the bond rates are right now and what the spreads are looking like, I think we're very, very close to it. We're probably, within about 0.1% or maybe 0.2% of the absolute bottom out point based on where we're at right now. So, if you are in a variable rate and you're thinking of locking in your mortgage into a fixed rate and waiting for that ideal time to do that, we might be very close or at that point right now.
So, what is it? So from an investor point of view, when you're, looking at applications, what are you guiding right now? Are you leaving it open to the investor to say, I think I'm going to do an open, or you like an open variable, closed variable, fixed? Are you actually giving some guidance to say this might be the right time to lock in?
Yeah, we give people that feedback, and I'm going to be putting into my next newsletter whenever I put out my newsletter, I put out a rate meter, if you will, kind of just to give people an idea of like where we're at and what my prediction of interest rates is moving forward. And so if rates now look like they're going to be flattening out and there's not really much of a chance of them going up or going down, I think we've kind of hit that low point. If you wanted to be in a fixed rate, but you took a variable rate because you wanted to ride that wave down, which was our strategy for the last 5 months, is go variable, watch fixed rates go down, and then lock it in later if you wanted to. That may be a good fit, but keep in mind, and here's a really big thing that we've been trying to educate our clients on, is that if you're locked into a 5-year fixed rate mortgage and you want to break that mortgage before the term is up, the penalty calculation today is going to be a lot steeper than what we've seen before. And these interest rate differential penalties, as I calculate it, assuming that there's no change in rates and you break your mortgage in 2 or 3 years, the penalty is about 5 or 6 times more expensive on average than if you were breaking a variable rate mortgage, because the variable rate mortgage is capped at 3 months interest, whereas fixed rates are either 3 months interest or this interest rate differential. So I've been running some numbers on like a $500,000 or $600,000 mortgage, and the estimated penalty might be $40,000, which is kind of nuts. So
yeah, so everybody needs to take that into consideration when they're doing that. So now, what about, off this topic of interest rates for a moment, what about what's going on with the bank in terms of approvals? Are things tightening up? Are we seeing more, I guess, hoops to jump through in order to get that mortgage? Is it getting tougher to get that mortgage, from the banks these days? And is there a bank that's better? Is there a lender that's, kind of a shining light in this mess, or what's going on?
What do you think?
I know the answer to that question. It is a little rhetorical.
Right? Yeah. Of course, it's tougher and tighter, and banks, whenever they see risk in the marketplace, they want to tighten up and make sure that they're lending to individuals who have a high chance of repaying. So what we're seeing right now is that lending is still happening, money is still getting lent out there. But if you're an employee and you're still working, then it's pretty much same as what it was pre-COVID. That really hasn't changed a whole lot. What you are starting to find, however, is if you are in certain industries and you're an employee, some lenders are saying, well, if you're in oil and gas, we're going to take an extra layer of review in that situation. Certain industries, they'll take another look. Where I've really seen a big change to the way that we handle processing an application is if you're self-employed. And so now every single application we go through, if you're self-employed, I have to ask a bunch of questions and look at, basically a COVID write-up on how COVID has impacted this person's business, what's happened to the revenues. I need to get 6 months of bank statements and make sure that the revenue is consistent with what their revenues were in the past. And so if your company financials for the last 2 years showed that you generally had $500,000 in revenue, but the last 6 months only shows a total of $100,000 in revenue, annualize that, that's only $200,000 in revenue. We have a pretty big situation on our hands. And we can still mitigate that by showing, yes, but we've actually dropped the expenses significantly, and so the net income is very consistent with the number. Or if we adjust the net income projections, then that number is still enough income to qualify the borrower. But it is a lot tighter, a lot more questions. Some lenders have changed some policies, and it's primarily a COVID-related situation where they say, hey, for the next X period of time, we're not doing this or we're not doing that.
Now, you mentioned industries where the banks are looking at certain industries and saying, okay, we're going to do an extra layer of diligence on this or look at it a little bit differently. Are you seeing that provincially as well? What's happening in Ontario versus British Columbia versus Alberta, Manitoba, whatever that might be. Are you seeing how they're looking at it through a different set of filters provincially as well?
Yeah, for the most part. So BC, pretty straightforward. Not a lot has changed in BC. Ontario is still pretty good, even though the COVID numbers have been a bit worse there. Alberta is really the one that's been hit the hardest, especially with our real estate investor clients, for instance. Some lenders tightened up and said, hey, you know what, we're just not doing rental properties in Alberta right now. Or if a client has more than 3 rental properties, we're not going to touch them. So we've definitely seen a scaling back, particularly in rental property clients in Alberta. So that's the big one that really has changed. We've seen little bits and pieces in Saskatchewan and Manitoba, not as much in Ontario and Quebec or BC. So that's what we're seeing right now.
What are banks doing? You'll use Alberta as an example. Are they then asking for a bigger down payment? Are you now saying, no, they want 25% or 30%? Is that helping to get the mortgages in that case? Or really is it just kind of off the table that if it's an investment property in Alberta, we're not really too interested right now?
Yeah, occasionally. So a lender, let's say, that says, hey, no more than 3 rental properties in Alberta max, we're not going to touch that client. Or if they just have in total more than 3 rental properties, regardless of province, we're not going to finance another rental in Alberta. Yeah. For the most part, those banks are very black and white. I did manage to get one exception with one of those lenders because the client had a really large liquid asset base, and so it was well mitigated. But in most cases, we're better off to just not even bother fighting with that lender. Let's just go to another lender where maybe you do fit, which may result in a larger down payment, because maybe with another lender, in order to qualify, you have to put a larger down payment down to make the deal fit. So yeah, I mean, not directly, like with one lender, you say, hey, we'll put more down payment, does that fit? Usually it's go to another lender and put more down payment to fit that lender's policy book and then fit it there.
Well, I think, this is really an interesting conversation. Within REIN, we say time and time again, make sure that you're working with an investor-focused broker like yourself. I mean, that's really your prime space that you hang out in, which is working with real estate investors to work around or overcome some of the hurdles that we face, driven by what's going on economically, in this case, COVID, and what that might bring. And to your point is that just because it doesn't work this way, which may be traditional in the thought process, doesn't mean that you can't come up to and work with another lender and still get the deal done. But that really does emphasize why it's so really, really important for a real estate investor to work with that investor-focused broker like yourself. But just, back to kind of off topic, but on topic with what's going on in banking, and it's kind of an ever-changing world, isn't it? It's, it's interest rates, it's tightening and loosening, and it's, the pendulum swings one extreme to the other. How has it been for homeowners, for example? So for those individuals that are thinking about buying their first home or buying their next home or upgrading, downgrading, I mean, there's lots of conversations right now of homeowners getting out of, for example, the downtown cores with their condos and getting out into suburbia or even into urban areas because of what's happened with COVID, needing to work from home, wanting more space, all of those things. How are the banks reacting to just standard homeowners? Is it pretty straightforward, or are they having to qualify at a little different level as well, Kyle?
Yeah, we're finding that that certain types of clients is a little bit harder to finance, but not a whole lot of change. So if you're a salaried employee and you're in an industry that's not considered high risk from the bank's perspective, then it's basically the same process, except interest rates have dropped to a full 1%, and now you're saving a bunch of money on your mortgage, right? Yeah. So it's not, and I think that's one of the reasons that we've seen such a spur in markets Canada-wide for the most part, is that if, let's say that you're applying for a $500,000 mortgage, a 1% drop in interest rates is going to save you $5,000 per year in interest. It's a pretty significant difference, right? And so if you're looking at buying a property, most people are looking at a 5-year fixed rate or a 5-year variable rate. Over a 5-year period, if the interest rate has dropped 1%, that's a $25,000 discount on that price. It's a pretty reasonable drop in cost, especially in the monthly payments. A couple of trends that I'm seeing right now is that we're seeing a lot more people move in the detached market. A lot of the detached properties, especially in Vancouver, that are over $1 million. It's multiple offers. I've had a lot of clients have to rate subject free on multiple properties in order to get one. It's pretty intense in that space. And if I look at it, it's generally people that are white collar, incomes over $100,000 a year that can afford a detached home. And so I think those markets are quite robust still. Condo market is actually performing quite well too, but not to the same extent that I'm seeing detached, because I think people are looking at, hey, let's just buy the house. We're spending a lot more time at home. Let's just have a bigger property that we can feel more comfortable in, and also an area where we're not touching a surface that 100 people during the day have already touched, like a condo.
Yeah. So kind of, off topic from that, but I think is what I'm interested in, Bank of Canada came out, whatever it was, 3 months ago, said, mortgage rates are going to be low or interest rates are going to be low for a very long time. Mm-hmm. And are you still feeling that? And here's the reason I asked the question, maybe we can talk a little bit about this, Kyle, is I do a lot of research on what's going on in the US, because I believe strongly that there's certain economic parts of what's going on in the US is really dramatically going to affect Canada. And I'm really just curious and interested in what's going on there. And I mean, the US is definitely a mess. I mean, to whatever degree Canada is, but you're not 360 million people, right? So anyways, the point is that there's a strong conversation happening in the US right now that there's going to be a shift in monetary policy, and they do expect inflation, and with that, significant increases in interest rates, okay, for US. Now, having said all of that, whether it's true or not, who knows? We'll see what happens over the next couple of weeks. The question is how closely connected or what's happening in the US on their interest rates to Canada. Do you have an answer to that? Like, is Canada going to automatically follow the US lead if interest rates start to rise? What's your view of that world, Kyle?
Yeah, I mean, there's a lot of moving parts when it comes to interest rates and how certain countries will interact with other countries, right? I mean, the reality is that U.S. is our biggest trading partner, and so there is some connection with our interest rates to what's happening in the U.S. If our largest trading partner is starting to increase interest rates, it starts to affect our dollar if we don't do the exact same thing. And so one of the things that we look at is, as a largely an exporting country when it comes to commodities, if the U.S. starts increasing their rates and we don't, it actually pushes our dollar up further. And that's bad for anybody who's looking at exporting to countries like the U.S. And so a lot of the time you'll see, like in 2015 when oil prices started to crash, the Bank of Canada moved down aggressively on interest rates because they needed to make sure that if oil prices are going down, let's make sure that countries want to purchase our oil by lowering our dollar. So there's a lot of factors at play here. The other thing that I'm considering too is I'm not so sure about inflation. I mean, there's a lot of money being printed, but at the same time too, I feel like when I speak to people anecdotally, and I'm feeling this the same for myself, is when I earn cash now, I just want to put it away just in case something comes up. And if money doesn't get put back in, then it doesn't cause inflation, right? So I don't think there's going to be the same amount of this much money gets printed, therefore we have this much inflation. I think it might be a lower amount of inflation per dollar printed that we've seen before.
Yeah, this scenario could lead to a self-fulfilling prophecy in terms of inflation, because people are being very guarded around where they're spending money. We of course don't know what's going to happen as we go forward with the wage subsidy programs or the business subsidy programs, and unemployment really will come to to what the real number is will start to come to fruition. So, this is a global issue. So to your point, I mean, there's so many moving pieces that impact an economy like Canada, and it's such a small population given what we're dealing with in the open market, right? So it's I guess it's to say that as we start to build portfolios, it's really important that we stay on top of what's going on in the marketplace. Mortgages, how do we make sure that we're buying the right property, getting it tenanted and the right tenant in that particular property, but also making the right deal with the bank so that we can have the next few years where that's handled and we can just get back to business, looking after our tenants and looking after our careers or our businesses, what that might be. Yeah. And so it's really appreciated, Kyle, that the experience that you bring to the RAIN community and the work that you do with our real estate investors and the knowledge that you bring. Just a big shout out to you for all the support that you offer the RAIN members, because I know you do a lot of work with RAIN members right across the country, and always appreciated. Any words of wisdom as we before we part this particular Facebook interview, Kyle?
Yeah, I mean the things that we're telling almost every client right now is just make an educated decision about where they're going to go, variable or fixed. I'll say that a lot of our real estate investors are still going variable, even though the fixed rates seem to have bottomed out. I don't think there's a lot of upward pressure with fixed rates, and so if you ever got worried, you could always jump in and lock into a fixed rate later. But the reality is an investor is much more likely to restructure, refinance, sell an asset, and not buy something else, which means you're not porting the mortgage and avoiding the penalty costs. And so as an investor, you're much more likely to pay a penalty on a property when you break that mortgage. Yeah. And the problem is that lender policies change all the time. So the lender that we set you up with today might not be the right lender for you later on when you have 2 or 3 rental properties more than you have today. And rental policies change with the banks all the time. So we find that they're more likely to break those mortgages. And if the penalty calculations are larger than what we normally will see, which I don't have enough time today to talk about why that is, but they're much larger and more expensive, then consider a variable rate, even if the variable rate is like almost the same as the fixed rate. It's right. The opposite of what we usually say, which is buy an insurance policy and go fixed. It's almost like buying an insurance policy and go variable, because then you avoid having to maybe pay a penalty that could be 5 or 10 times more expensive later.
I think, in the world of risk mitigation, flexibility in an environment like this is really important. And some of that flexibility means being sure you're not over leveraged as you go into this environment. I mean, it's been pretty, although confusing and a little complex, the real pain hasn't started to set in. There's always a lag time with an economy. That lag time is going to start catching up to us in the coming months. And this is a time for real estate investors to make sure that on the financing side of it, that they're looked after and really clear on what they got going on.
Yep, exactly. Yeah, the only other thing I'll mention too is that it may be worth considering breaking your mortgage and paying the penalty to lock into a lower rate, especially if you did want a long-term fixed rate. Because if you can have a rate of 2% for the next 5 years, as opposed to maybe your renewal comes up in 2 years' time when you'd expect maybe the market starts to recover at that time and rates are higher when your renewal comes up, it may make sense to do that, and we can help with that analysis. But it really depends.
That's such a pro tip. I think as investors, please don't make the assumption that, paying a penalty is, is not worth it, because sometimes it is absolutely worth it. And to go to that different rate and different mortgage. So that's just a great pro tip. And you guys work through with investors in that, you do that analysis, you look at what they got going on, help them make that decision.
Or so you should see my spreadsheet.
Okay, you and Jennifer Hunt, you guys and your spreadsheets. Okay, well, I'm really, really happy for you. So that's awesome. Kyle, appreciate your time as always, and thanks for joining me today.
Yeah, thanks, Pia.